Welcome back to Econ class, guys. Today we're going to look at the circular flow of economic activity. All right, but before we get into that model, we have to look at the factors of production. Factors of production are the resources used in the production of goods and services. All right, now this could be your labor, this could be your natural resources, these could be the machines, the vehicles used, the tools that the workers use. Any of that, including the entrepreneur themselves, are considered to be the factors of production. And we'll break them down in the next slide. But before we move on, just to differentiate how factors of production are viewed in a market and a command economy. Now, a market economy, the invisible hand guides everything. The optimizing individuals and their decisions are what are making the what, how, and for whom decisions. So in a market economy, the factors of production are owned by the individuals. They are valued because of the profit that they can make them. So there's a profit incentive, optimizing individuals, doing what's best for themselves. That's how the market economy handles things. In a command economy, it's all about the greater good. So, and there's a central planning agency, the government or the country as a whole owns everything. So the factors of production are owned by everyone. And the decisions are made by whatever planning agency they have. They are valued specifically based on the usefulness to the people. Not how much profit there is, but how they can fulfill the needs of the people within the command economy. All right, now, let's break down the 4 different types of factors. First, we have land. These are the natural resources, the livestock, minerals deposits, oil, the land itself. This is all part of the land factor of production. Now, when a business buys the land from the households, we consider that paid in rent. Okay, so rent is the term used for this particular factor. When we get to labor, the payment is in wages. All right, labor is the productive work. It's the main factor of production that most individuals or households offer the factor market or offer the economy. The other two, we got capital. Capital is probably the most confusing to understand because it often gets confused with financial capital, money. Capital is not financial capital. Make sure you differentiate between them two. Capital in this sense are the machines. They are the tools. They are all the man-made goods that are used in the production of other goods and services. So remember that, not financial capital. But in this case, instead of rent or wages, we call it interest. The last one, entrepreneur. He's the guy that puts everything else together, the other 3 factors of production, and he is paid in profits. Okay, so we have the land, the labor, the capital, and the entrepreneur. And when they are purchased, it is either in rent, wages, interest, or profits. All right, now before we move on to the circular flow model, I want to talk about economic models in general. So economic model is basically just a simplified model of something more complex. It's taking a complex idea, breaking it down to its most simple form, and putting it in a way that we can actually understand. So it relies on a lot of assumptions, but it helps present the idea in a way that we can actually visualize. Whether it is a simple equation for GDP, C, consumption, I, investment, G, government, and NX, the net exports, equals our GDP. So this is a model of the gross domestic product of our nation. This is the supply and demand curve. It helps explain the price system, the entire market economy. This is probably the most used model in microeconomics right here. Right here we have the production possibility frontier. It helps us visualize opportunity cost, wasted resources, what we're actually capable of producing. So each one of these models helps explain a much more complex concept. No matter what the model is, its main goal is to simplify. So the circular flow of economic activity it's a complex idea, but it's really simplified in the model below. So there is a simple model that we're looking at here, and there's a more in-depth model that includes government and the rest of the world and the financial institutions. In AP Micro, you basically only need to know this simple model. All right, in this model we have households, firms, factor markets, and product markets, okay? It's showing the relationship and the flow of money, goods, services, and the factors of production and the interdependence that they all have on one another. So let's take a look at how this works. We see the money flowing from the households through the product market. The firms then use that same money to buy the factors of production from the factor market. which is provided by the households. The households then use that money again and it flows back around. So the money is flowing in one direction when we have the goods and services and factors of production flowing in the other direction. The households provide the land, labor, capital, and entrepreneurship to the firms. The firms then use those resources to produce goods and services, which are sold in the product markets to the households for the income that they earned. So it seems complex, but the model really, really simplifies it. So let's break it down. We have our households, or otherwise known as individuals. They own the factors of production, okay? That's one separation we have to make. The individuals own the businesses, but they also own the factors of production. The firms and businesses are considered to kind of be separate entities in this model here. So the households own the factors of production. They sell or rent them to the firms. They buy and consume the goods and services that the firms then produce. Okay, that's the role of the households. The role of the firms or businesses, they buy, hire, or rent the factors of production. They then take those factors of production to produce goods and services, which are purchased by the households when they are sold in the product market. So let's take a look back at this circular flow here. The circular flow model is just a visual model simplifying the economy. All right, it's simplifying everything that happens in our economy. We are making an assumption that it is very, very simple in this particular model. So once again, we're watching. The households are spending money. This is me going to the store to buy a pair of jeans in the product market. The cash ends up in the hands of that company that sells the jeans. They then use that money to produce more goods and services, but they need factors of production. They get those in the factor market. The factor market is where factors of resources are bought and sold. The households are the ones that provide the factors of production to the factor market. All right, these two markets that we're talking about. First, we got product market, okay, or the goods market or the consumer goods market. This is where finished consumer goods and services are bought and sold. All right, this would be your Target or your regular grocery store that you go to, anywhere that consumers buy and sell or where consumer goods are bought and sold. The factor market is where the factors of production or the productive resources are bought and sold. Okay, so the labor market, for example, would be one factor market. Maybe your local Home Depot would be another factor market. So some of these markets act as both. A Home Depot might be a product market to some people when it might be a factor market to others. That's what I mean. We're making assumptions here. We're separating everything. We're separating the individual from the business. We're separating the markets, based on what they're selling. It just helps us to understand and provide a visualization of the whole economy. All right, so one more time, just to kind of cover it again. We have our households, we have our firms, we have our product markets, we have our factor markets. Most of the questions that pop up about this concept ask which direction the flow is going, or what is the role of a particular market or a particular entity within this particular model. So let's take a look at one more time. The households, they provide the cash. They go to the stores, they buy goods and services. The firms end up with the money. What do they do with the money? They buy land, labor, capital, and issue profit to the entrepreneurs. So that cash flows through the factor market back up to the households. This demonstrates a lot of interdependency here. The households need the income from the firms. The firms need the income from the households. The firms need the factors from the households, and the households need the finished consumer goods and services from the firms. So there's a lot of interdependency. This is why when one person gets laid off in our economy, it starts to get a little dangerous because he stops buying goods from the product market, firms have a little less income, and they might not be able to hire or rent as many factors of production. And that puts somebody else out of work. So it snowballs out of control when we start to lose jobs, when incomes are lost. So everybody is tied together in our economy. The interdependency is plain as day using this model. All right, guys, that's it for today. Hope you understood the circular flow of economic activity. Please check out the next video, which we are dealing with marginal decision making or marginal analysis. Take care.